Hello, everyone, and welcome to today's webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor at Subprime Auto Finance News. In today's webinar, Need Money? Doing a capital raise and the current state of the capital markets. We have a great session in store brought to you by Payix together with Visa. But before we get started, just a couple quick housekeeping items for today's session. We are recording today's webinar and we'll make that recording available to you as soon as possible. So just keep watch of your inbox for a message containing a link to it. And you'll be in listen-only mode for this webinar, but just use the chat function here on the Zoom platform to ask questions when you would like to do so. So let's get right into today's session featuring David Francione, Managing Director, Financial Technology and Payments at Capstone Partners, and Christian Sente, Partner and Co-founder of Creative Co. Gentlemen, looking forward to the presentation. Thank you so much.
Thank you, Nick, and welcome everyone.
So hello, everyone. This is Christian Sente. I'm a partner at Creative Co. We're an early stage B2B SaaS investor, so primarily investing in the seed stage. So just wanted to give that as a background because my perspective might be a little bit different from David's, who's investing a little bit at the later stage, so Series B, C, and helping his clients there. So capital raise overview. So you could kind of look at capital raising in three different stages. So hey, I have an idea. You typically want to either you're self-funding it, bootstrapping it, but generally there comes a time where you're spreading yourself a little too thin and need a little extra capital. So typically what you do is you go to friends and family for the friends and family round. That'll help you, from a software perspective, that generally you're using friends and family round to fund the development of the software and generally getting to an MVP or minimally viable product. Once you got a MVP in the market and you're starting to get some revenue traction, that's generally when you want to raise like a pre-seed or seed round. And this is typically you're raising it from angel investors are like angel investor groups. And this money is used just to, help accelerate the product. So you have a product in market, you're starting to get revenue traction, and now you're, using this money to kind of build the team around it to help accelerate growth. And then you get to the third point here, which is, private equity and venture capital. So venture capital, just broad overview, is early stage and private equity is later stage. And so after the seed round comes I'm sure everyone has heard the Series A, B, C, all the way down the chain. And that's, typically when you want to get an intermediary involved. Before that, it's not, the processes aren't very long. They're easy to manage, the fundraising process as well as operating the business. Once you get to a little later stage, we're talking about raising millions of dollars. So a typical Series A could be anywhere from 5 to 10 million. It becomes kind of a hard process to manage yourself. And personally, we've invested in companies where they either had an intermediary or didn't. And the ones that didn't have intermediaries, it's very hard. It's like the CEO, the founders always say, man, I'm so happy I'm done with fundraising because now I could get back to doing business. So yeah, it's a very big distraction. So yeah, I mean, I'm sure David can pop in and share some experience there, but
Yep, it's good point, Christian, that you make. The typically the larger the round is more when an investment bank, such as a capstone, who's focused on different industries, you find an intermediary or a broker or advisor that really understands the industry, the product, the landscape, and a lot of the potential investors that might be interested in a particular product, the company, the total addressable or size of the market opportunity, whether it's domestic or international in nature. And they'll help you navigate all of the pathways and avenues to finding the right capital and the right partner at the right time, only because they have a lot of the relationships, such as you and I, Christian. So we kind of know what you're looking for from a business plan perspective and a model and an opportunity, and how much you might be able to invest in any particular round, whether it's an A, B, or C type of round. And so we can help the company guide through those decision-making processes in a timely fashion, so the company can really focus on kind of what they do best, building a product and kind of going to market and running a business. Because otherwise any kind of capital raising event can take over the entire resources of the company.
yeah, absolutely. I think we could go on to the next slide, David. So valuation,
See that?
yeah, valuation basics. So how do we get to a what's termed a pre-money valuation? So the three methodologies outlined here are discounted cash flow, precedent transaction analysis, and public comps. So discounted cash flow, or DCF, it's pretty much a direct valuation technique that values a company based on projecting its future cash flows, and then using the net present value method to value those cash flows in today's dollars. Precedent transaction analysis. This technique basically looks at similar transactions that took place within the marketplace, and you either find a mean or median for those deals. And then public comps, as it sounds, it's a method that looks at publicly traded companies similar to your company. And then so once you have all these valuations, you can apply certain weight to each method to arrive at like a pre-money valuation. Like, for example, there might not be many similar public companies, so you would weigh the public comps method much less than discounted cash flow or precedent transaction analysis.
And to Christian's point, each one of these methods can be applied to different companies at different stages of their life cycle. Some are a little more applicable than others. And in each one of the methods, there's pros and cons. A lot of them are driven by estimates, pure estimates, and others have a lot of different variables that could potentially change over time. That's to use all three in a combined fashion, weighting them differently, depending where the company is, probably makes the most sense. And the other method that's not listed here is kind of looking at other recent financings in the market to see if you can glean any information in terms of how much maybe that company raised, at what stage. Did they have revenue? Was it pre-revenue? How much revenue did they have? How many customers did they have? If they really didn't have any revenue, they were giving a product away just to get some traction and validation in the market. That's called a freemium. And you can create an implied value per customer. If somebody has 30,000 customers, but they're pre-revenue still, or maybe minimal revenue, you can kind of figure out what the metric is of how much they raised and how much they kind of paid per customer, if you will, or subscriber. And as another sort of method, because once you kind of go to market and you figure out, having conversations with Christian and other firms, really becomes more of an art than a science in terms of how do you actually get to evaluation. And so everybody sort of looks at these in sort of back of an envelope type of calculation and kind of come up with some sort of range that kind of makes sense, where people feel comfortable. Anything else on that slide, Christian?
No, could go to the next slide, please. So what we, those three valuation methodologies get us to a pre-money valuation. And the pre-money for a particular round is negotiated between the lead investor and the company. So let's say after going through our valuation analysis, we think the company is worth 100 million. And the investor wants to put in 50 million. So the post money is simply the pre-money plus the new money that you're raising, or in this example would be 150 million. So on a fully diluted basis, this would give the investor 33% ownership of the company. So 50 million divided by 150 million. And this is a very basic example that we're demonstrating, and things can get a much more complicated after taking into account, say, convertible notes or warrants, which all increase the post money in addition to the new money being raised. So in addition to the previous methodologies mentioned, and David lightly touched on this, there's many company-specific variables that can either enhance or detract from the valuation of a company. And in my line of work, like we don't use really discounted cash flow because the companies are so early and they're SaaS companies, so they're likely not going to be profitable for 10 years or never. They might never be profitable, so it's hard to perform a DCF. So for early stage SaaS companies, I think the most important metric for us is revenue growth. So the faster a company is growing, the higher the revenue multiple will be. And kind of in line with that is recurring revenue. So how much of the business's revenue is contractually obligated revenue, or SaaS or subscription revenue. So that's why SaaS companies are valued so much more than just a traditional software company. And then the third, I'm going to go a little bit off of the off topic here, but another metric that's super important is churn. And in SaaS, churn is a killer and is like the main barrier to growth. So a SaaS company with really high churn is pretty much unfundable, and like no one will touch it. So for example, say you have a SaaS company with 2 million in ARR, which is annually recurring revenue, but you have a 2.5% monthly churn rate. So this means you're losing 600K in ARR per year. And if you don't add any new revenue, you'd be at 1.4 million at the end of the year, since you lost the 600K revenue. So said another way, you have to add 600K in new ARR just to have flat growth and remain at 2 million in ARR, which this gets us to the next point is net revenue retention. So this calculates your ability to retain and expand customers. So essentially it's total revenue, including expansion, minus revenue churn. So a company with 120% net revenue retention is adding more revenue than it's churning. So generally a percentage above 100 is a great thing. And then there's also gross margin. Like in my line of work, since we're focusing on SaaS companies, like most SaaS companies are 85-90% gross margins. Revenue concentration. So do you have, of the 100 customers, does any one customer or a group of customers make up the majority of the revenue? That's always like a red flag and can detract from valuation. Size of addressable markets also another great metric to track, because is this market large enough to be able to sustain a say $1 billion company, or is the market large enough to be able to share amongst several competitors? So the total addressable market's a very important metric when you're looking at potential the potential ability to generate future cash flows. We can go to the next slide, David. And one thing to add on valuation is right now it's a pretty crazy market, and valuations have gotten fairly out of control. At the seed level, it stayed relatively equal to years past, but the moment you start getting into Series A, it's the valuations have just skyrocketed. So I could give you an example, a personal example from our portfolio. We did a investment into an enterprise SaaS company, and it was a 3 million round at a 12 million post money valuation. The company was doing around $1 million in revenue, so 9 to 12x revenue multiple. 6 months later, the company was at around 2 million in annually recurring revenue. And they got a term sheet that they signed and closed. So they did a Series A. It was a $9 million financing out of 53 million post. So that's a massive jump in valuation, but not a massive jump in revenue. So revenue maybe doubled, but the valuation quadrupled. So just another example of the markets are pretty hot right now, and it's, as a founder, it's a really great time to raise some capital. So why raise capital? So what we're seeing mainly at the seed stage, the companies at a point where they have a product in market, they're starting to generate revenue, but essentially they need to decide on whether they're is this going to be a lifestyle business, or are we going to scale this thing to its maximum potential? And if the latter is chosen, you need to build that team around the founders and around what you have so far, and you need capital to do that. So hiring talent and building out the team is generally the number one thing why companies raise capital at the early stage. Additionally, they might have, in the software perspective, they might have strung together some MVP. They hired some outsourced some developers, and it's a super clunky product held together by rubber bands, but that product is in market and it's made money so far. And so now it's time to professionalize the product and make sure it can service the customers correctly. And so that's why a lot of the uses of capital additionally is used for building out the development team, which is like investing in technology. And then there's also, in terms of building out the team, at the early stage, the number one area of investment around the team is like sales and marketing. So usually when a company's at a seed stage, they have maybe one salesperson, and that salesperson is usually the founder. And so they need to actually build out a sales organization in order to scale properly. David, I think you could probably talk to acquiring other businesses, because at our stage, that's generally pretty rare that seed or Series A company is picking up add-on acquisitions. But I'm sure at your stage, you see that more often.
Yep, I would agree. A lot of times, given where the state of the capital markets are, and especially the sector that we cover, which is fintech and payments, so it's financial software, and anything electronic payments wise, because of the frenzy and the level of activity in that market globally, companies are raising more capital at an earlier stage and at a higher valuation. And we had a call with a company today that just raised $100 million, and they're already making an acquisition, and it's a Series A, so first real institutional outside capital in the company. They bootstrapped a company to date. So there's opportunities in certain areas of the capital raising process where an acquisition might make sense, either to reduce the time to market for the product and to bolster additional functionality and features to broaden the product set instead of adding more developers. there may be a discounted company out there that they can acquire pretty quickly. But in the earlier stage, just generally less so. Anything else on this slide?
Maybe, I mean, we should touch on,
Maybe the
when to
control
start a
program.
capital raise process, and that's a fairly hard question. I mean, if you're just starting out and raise a friends and family round, I mean, you start when you when you have the idea. But once you start getting a little later stage, like, so when do you start raising a seed round? When do you start raising a Series A round? Most investors are going to have kind of thresholds where they're willing to invest at. So, generally a Series A is done once the company's at, say, 2 to 3 million in revenue. A seed is, you're anywhere from 300K to $1 million in revenue, and these can be all over the board. I'm giving the perspective from Southeast. If you go West Coast, it's throw what I just said out the window. They're much larger rounds with much smaller revenue.
And I think the companies that we come across sometimes, and sometimes we might see them the same time as you. Sometimes we get to them before you might see them, and so they're sort of prepped already. And so just the preparation in the sort of the startup mode, you always have to have your eye toward your next round or the future. When you don't, the best time to raise capital is when you kind of don't need it, but every early stage company needs it until they get to a profitability. And like you said, if they ever get to a profitable state, well, usually because it takes, call it 6 months on average or so. Maybe it's a little quicker these days to get a close around. By the time you start conversations, put together some pretty good information to present the business position in its best light. If you think you're going to run out of cash or need capital at some point next year, and you just got a small family and friends round today, or maybe your first VC round of $500,000 or $1 million, kind of really look at how you can allocate your capital efficiently in the business, when and how, and then kind of always have that eye toward, okay, am I going to need more capital at some point? And if so, let's start thinking about that at least 6 months to 9 months ahead of time, if you can.
Right. And what we've seen as a pattern lately is, a company raises a seed round. They're at, say, $1 million, $1.5 million, not quite at the Series A, but they're starting to run out of cash. But they're not big enough for a Series A, and they're too big for a seed. So what we've seen a lot are these, they're called like internal bridge rounds or convertible note bridge rounds, where the company goes to their existing investors in order they say, hey, I need another 12 months of runway to get me to 2.5, 3 million, in which then I can go raise a proper Series A. So there's always, I mean, it's definitely a balancing act, and always have to keep your eye on your cash balance and your burn. And sometimes, burn can get out of control, and what you forecasted isn't quite correct, and you need capital now. So it's definitely a balancing game with cash budgeting.
That's right. I think one of the other questions is what type, and this is a little more off topic, but what type of capital might a company benefit from, whether it's venture capital, like Creative Code Capital, or potential strategic. And sometimes the decision tree comes down to maybe in a certain financial services or fintech vertical, the name of the game is distribution. Instead of building a sales force, going to market in a direct sales channel strategy, you go indirectly through a partner, and maybe that partner is sort of strategic. They can use your technology, and they have 20 salespeople that can resell as part of their broader solution set. And also they value an investment into your business. So it's sort of a friendly investment. It has its pluses and minuses like everything else.
Yeah, in that sense, traditional venture capital or strategic investor, if you go with the VC, you're generally giving up some control of the company, and you're generally giving up one board seat. So from a strategic investor perspective, it's a little more like, I would say, founder friendly and a little less hands-on than a venture capital firm would be. I think we can probably go on to the next slide. Yeah.
All right, I know we're running short of time. So the second sort of half of the presentation here is more on the state of the markets, fintech in general. What is fintech? Everyone's read about it. It's finally seen its heyday over the past 5 to 8 years. The way at least we define fintech is any sort of software applications, data analytics that tend to be sold into an insurance company, a bank, brokerage firm, capital markets, asset manager, and then electronic payments. Anything that is front, middle, or back office. Could be processing, could be digital wallets, anything that automates sort of the movement of money. And so fintech is really insurtech, bank tech, wealth technology, things that automate the movement of money or some sort of financial transaction. Could be a claim, an insurance company, could be a securities transaction when you buy a share of stock, for example. So there's a lot of what we focus on tends to be B2B. So business to business is one of the bigger categories in fintech, and it has a B to C flavor as well, because sometimes the ultimate end user could be a consumer, or what they call a retail person. Over the past 10 or 15 years, we've seen a pretty big dislocation in the market where there's a lot more money to be invested. We're calling PE as private equity, but it includes earlier stage, basically venture capital, all the way up to what they call buyout funds, which is where they use equity and debt or leverage to acquire companies as opposed to just investing in them. And so there's always been more capital than there are companies to invest or acquire. And so that supply demand imbalance tends to create a scarcity value. And you see the overhang here, which basically means how much money on an aggregated basis in the United States for all of these VC and private equity firms is on a combined basis available for investing. So currently it's over $1 trillion, which is unprecedented. So,
And on that point,
more than double.
Sorry, go ahead, David.
No, go ahead.
I was going to say on the point, to make this point a little more clear, is one thing we're seeing also is say like 10, 15 years ago, private equity wouldn't even like touch software other than the pioneers of software tech investing. Nowadays, like, private equity is starting to move more and more downstream. It's more and more comfortable with software, and that allows these early stage companies a new path to liquidity that wasn't there in the past. So for example, we've seen, some of these growth investors and buyout investors, they used to have a 10 million minimum. So if you weren't even at 10 million, they wouldn't even bother. And that over the last 5 years has gone down and down and down. And so now it's, 5 to 7 million is where you can potentially get a recap. You can actually take some chips off the table, get a second bite of the apple. But it's interesting to see that it's like more and more, like David said, it's a function of the competitiveness of the industry. There's so much money chasing so few deals that it's starting to push more and more private equity lower and lower and more downstream, which is a good thing for founders. It gives them, like I said earlier, another path to liquidity that wasn't there just 10 years ago.
And keep in mind, this one slide is just the private capital markets. There's all of the cash that are on the balance sheets of the big, call them FANG companies, any software company, well, it's Oracle, Microsoft, IBM, Facebook, Google. They're sitting on records amounts of cash on their balance sheet. So they have corporate VC arms now making investments, such as PayPal. And that's another, I don't know how much it is, 800, probably almost $1 trillion just in that category alone. So there's a lot of capital out there these days. It's not always easy to get it, but it's available. And here's some of the venture capital, fintech related deals, as you can see, quarter over quarter over the past several years. The amount of deals and the values have both gone up. And just looking at 2020, we had a little bit of a dip mid-year, and then the values have gone up quarter over quarter since the latter part of 2020. And that's at least projected to continue for the foreseeable future. So as Christian said, now is the time if you're going to raise capital. Valuations are at an all-time high, so it's good to be raising capital today. Not always easy to get. And as you can see, some of these charts segment the amount of capital that is available, that has been invested by venture capital firms like Christian's firm, by stage of company. So you have the angel and seed, which is where Creative Co-Capital plays, and then crossing over to early stage VC, then later stage. So later stage is post-revenue generation, maybe break even, but probably not, generally speaking. So you can see the values of those deals keep continuing to increase, as well as the counts continue to, they're fairly stable, but each stage, later stage is attracting a little bit more capital these days in general. I think that is it for our presentation. Any parting shots, Christian?
Yeah, looks like there was a question that came through, and it asked, can you speak of the average type of multiples we're seeing for seed round and Series A round? So from my perspective, for SaaS, at the seed, you're generally, and this is, again, it's dependent on a lot of company specific variables like growth, net revenue retention, churn, all those things we talked about. But if you have a solid SaaS company that's growing, say 100% a year, pretty little churn and good net revenue retention, at the seed round, it's anywhere from 10 to 15x. So 10 to 15 times your ARR. And then it's fairly, once you get to the Series A, if it's that same company, that's where the valuations are starting to get a little crazy, and you can see 20 to 40 times revenue. For example, we have a portfolio company that's doing around $1 million in ARR, $1.5 million in ARR, and they're turning down term sheets at 10 at 40 pre. So just to give you a taste of like just how frothy the markets are right now.
Quite the current landscape described here by David Francione, the Managing Director, Financial Technology and Payments at Capstone Partners, and Christian Sente, partner and co-founder of Creative Co. And a lot of great information, gentlemen. We do appreciate it. Again, we are recording today's webinar, so keep watch of your inbox for a recording of today's session that you can revisit the information and insights shared here and shared with your partners at your startup. And gentlemen, as the questions have come in, and we certainly welcome yours through the Q&A function or the chat button here on the Zoom platform. One perhaps maybe an obvious question. Christian, we'll start with you, and then David, to your perspectives as well. If a company currently isn't profitable, or perhaps the outlook is bleak for it to turn a profit, why would an investment firm push resources into that company? Christian, we'll begin with you, and then David. If a firm is not showing profitability, why would it be appealing?
Yeah, that's a good question. And from my perspective, we generally don't even look at profitability, to be honest with you. Software companies are valued on a revenue multiple. So profitability is really not a thing we really care about. Maybe once you get to the Series C and later on, profitability starts playing a role. But for early stage software, it's all based on revenue and revenue growth. And like I said before, the churn, net revenue retention, all those take front seat to profitability.
Very good. And David, how about your perspectives?
Yeah, so some of the companies that we advise, and it's just a matter of where we focus, they tend to have to be profitable to show profitable growth. And there's always this software rule of 40 that they call it in Silicon Valley. It's been around for decades. The growth rate on a combined basis, revenue growth year over year, plus the EBITDA margin generally has to meet at least the total value of 40 or higher. The higher it is, the more the value is. So a lot of the companies that we advise, they have to be profitable only because we're going to be helping them with more of an exit strategy. Sometimes it's capital, but it's a recap and later stage. And so some of those types of investors, they want to see profitable growth. And if they're going to be exiting the company, although revenue is always key in the SaaS market and the churn, high customer retention, all of those metrics are incredibly important. But on top of that, they also have to be profitable for us to take them on as a client.
Yeah, and one thing to keep in mind, if you look at like public SaaS companies, a lot of them are not turning a profit. But if you take a closer look, they're all still growing relatively fast paced, 80, 100% year over year growth. But if you take a closer look at their expenses, they're spending a lot of their resources on sales and marketing. So if you take any of those public SaaS companies that are not profitable and you turn off sales and marketing for a quarter, they'll be highly profitable. So that's how kind of investors look at it. So it's like the potential of cash flow, not what it is at the time.
Very good. And continuing with you, Christian, and David, if you'd like to chime in as well, just to clarify, just for our audience, especially from viewing it through the investor's prism, how do you define revenue and profit? Just so we have a baseline understanding. Again, Christian, we'll turn back to you. How do you define revenue? How do you define profit? And David, your perspectives as well.
What do you mean by defining revenue and profit?
Like how would you, if you're looking at a company's financials, how would you calculate revenues or profitability? Just so that for someone who might not have as much investment world experience and might be unclear how revenue and profitability.
Oh, I got you. Yeah. So I mean, revenue is the amount of money the company brings in, whether that's, if you're a SaaS company, that's, how many users you have using the product. And the profit would be your revenues minus the total expenses of the company.
Very good. Very good. Again, our special guests here on our webinar brought to you by Payix together with Visa. Need money? Doing a capital raise and the current state of capital markets with David Francione of Capstone Partners and Christian Sente of Creative Co. And gentlemen, another perspective, time frame oriented question. Again, as you've alluded to already, that the current environment appears to be ripe for investments. David, we'll turn back to you, and then Christian, your thoughts as well. How does the current environment compare to some years past? How much more ripe for raising capital are we standing in now as compared to some of the recent past? David, we'll continue with you, and then Christian as well.
So even though there's continuing to be record amounts of capital available, it's not very easy to actually get it and close a round. Things do take long, and there's a lot of opportunities that firms like Christian's are looking at, and there's only so many man hours, so to speak, in a day. And so there's resource constraints that allow them to invest and pick sort of a horse to ride, if you will. And so not all business plans and ideas kind of make it to the funding stage, and some could be really good that just don't get the funding. So there's a lot of opportunity out there to raise capital. It's just a little bit difficult navigating those waters today because the market is so crowded, and to get anybody's attention is very difficult. So you have to do whatever you can to really attract attention to a potential investor.
Yeah, that's a good point. There's record amounts of capital. So excuse me, more and more capital seems to be chasing less and less deals today. So excuse me. So yeah, it's what we look for. It's, if you are a company that have hit all those metrics that I mentioned earlier, and are solid growth, solid metrics across the board, it's fairly easy to find a capital source because there's so much capital out there. On the other hand, that doesn't mean that a mediocre company can raise capital easier in these markets. It's just, it's almost like the availability of capital has increased, but getting it isn't guaranteed, like David's point. So it's competitive on both sides of the equation.
Indeed. Closing moments here on our special webinar brought to you by Payix together with Visa. Need money? Doing a capital raise and the current state of the capital markets with our special guest experts, David Francione of Capstone Partners and Christian Sente with Creative Co. And their firm websites and their respective email addresses are there on the screen. And gentlemen, to round out our conversation, since the conversation began and our audience derives quite a bit from the automotive space, David, we'll turn back to you, and then Christian had the last word. Just in light of how much development there's been with how consumers can shop for a vehicle, can secure financing, can maintain the payments for that vehicle, and just the automotive segments in general, just how do you view the investment thirst to delve into automotive? David, your thoughts there, and Christian to round us out.
Sure, it's a very, very large market opportunity globally. It's growing tremendously, and there's been a lot of not just recent activity, but with the electric vehicle, a lot of new technologies being incorporated and integrated and embedded with, whether it's a self-driving car, and making the whole buying process much more streamlined and automated, all the way down to the payment process. There's a tremendous opportunity. Very fragmented market, still in its sort of earlier stages. So big runway ahead.
Yeah, I would echo that, and it's, when you look at auto fintech, it's just a massive market with a bunch of different sectors, from on-demand transportation, billing, fleet management. It's massive, and it's ripe for disruption.
Very good. Great way to leave our webinar today. Again, that's Christian Sente, partner and co-founder of Creative Co., and David Francione, the managing director of financial technology and payments at Capstone Partners. Gentlemen, thank you so much for sharing your perspectives for this webinar brought to you by Payix together with Visa. Thank you so much again, gentlemen.
Great. Thanks for having us.
Thank you.
And on behalf of all of us at Cherokee Media Group, we thank you for joining us, and we look forward to having you again next time.